Well, good afternoon and welcome everyone. Thank you for spending your lunch break with us. My name is Jamie O'Connor and I'm with Family Voices of Minnesota and Connected. If you are not familiar with Family Voices of Minnesota, our primary goal is to provide information, assistance, and support to families who have children with special health care needs. We offer resources and information around different systems of care, including financial, health care, educational, community. We have over 180 volunteer support parents throughout the state of Minnesota, so we often connect parents with other veteran parents who have similar needs or experiences. We offer emotional support, understanding, and acceptance, and a lot of encouragement and education to support families. Family Voices of Minnesota is the state affiliate organization of Family Voices National, and our Connected program is the state alliance member of Parent to Parent USA. Today I'm thrilled to introduce Scott Stevens, who is in Bloomington, Minnesota, and is a family planning lawyer, and who also has a child with a special health care need. Scott has volunteered his time coming off of this crazy upper respiratory thing that's been going around. So thank you, Scott, for being here, and we will understand if you have to mute yourself to cough. We don't mind.
Okay.
So
thank you.
We're covering, this is part one of a two-part series on special needs planning, and this is I like your title, Scott, and I wish I had used it in the other promotions, but special needs financial management options, or special needs accounts. And with that, I'll let you take it, Scott.
Okay, so just a little background in basis. There are millions of individuals with disabilities and their families who depend on a wide variety of public benefits for income, health care, food, and housing assistance. Eligibility for these public benefits, and I identify a few of them on my slide, such as SSI, SNAP, Medicaid, require meeting a means or resource test that limits eligibility to individuals to report more than $2,000 in cash savings, retirement funds, and other items of significant value. Realizing the need to protect the assets of disabled adults while maintaining their eligibility for government support, the government over the years has authorized and created several statutory options for managing the finances of individuals with disabilities or special needs that does not affect their eligibility for SSI, Medicaid, and other public benefits. The financial management options that are authorized and created by the government secure funding for disability-related expenses on behalf of designated beneficiaries with disabilities that will supplement but not supplant the benefits offered and provided through private insurance, Medicaid, SSI, the beneficiary's employment, and other sources. So several of the special needs financial management options are ABLE accounts. Those are tax advantage savings accounts for individuals with disabilities and their families. There's also Special Needs Trust. That's a trust established for the benefit of a person under age 65 who is disabled, and that allows the disabled person to remain eligible for medical assistance, supplemental security income, and Minnesota health care programs. There's also the Supplemental Needs Trust, and that's a trust that's established and funded by a third party to provide for the supplemental needs of a person living with a disability while allowing such person to remain eligible for medical assistance, supplemental security income, and Minnesota health care programs. So with that quick overview, we will now go into a more in-depth review or discussion of the different options. So an ABLE account is a tax advantage savings account for individuals with disabilities and their families. The account owner is the beneficiary of the account. The income earned by the ABLE account isn't taxed so that the owner's wealth will grow faster. However, when the owner takes money out of the account, he or she has to spend it on a qualified disability-related expense. Otherwise, the withdrawal will be taxed as income. Any person, whether it's the beneficiary, a family member, or friends, can make contributions to the account. but it's highly recommended that it's only the person with the disability who makes contributions to the account, and I'll explain why in a little bit. The contributions must be made using post-tax dollars or after-tax dollars, and they are not tax deductible for purposes of federal taxes. However, some states may allow for state income tax deductions for contributions made to an ABLE account. And for those types of questions, you would want to consult with your accountant as to whether they are tax deductible in Minnesota or in your state.
Hey, Scott, can you give some examples of qualified disability-related expenses? Is that only like medical or transportation? What are some examples?
Well, it's, let me go back a slide, sorry. So they did I go too far? Hold on here. Oh,
No,
okay, yeah. And so they're going to be things essentially that are going to supplement, again, sort of what the government is providing, because the purpose here is not to replace, it's to supplement. And so it's going to be expenses that it could be not necessarily all medical expenses are going to be covered. There could be, sort of, what is the word I'm looking for here? Deductibles that the person will need to cover, or there may be certain medical supplies that will not be covered by all of the different SSI or by MA or some of the Minnesota health options. And so those are the expenses. And I could go into more detail. I was just trying to do a quick overview, and so I didn't do a deep dive on that, and I apologize for that.
No, I was just curious.
Yeah. So, oops, did I go too far? I think oh, this went out of order, I think. Oh, let me see here. I'm sorry, I'm trying to.
No, I'm sorry. I think this might be where I messed your slides up a little.
Okay. So I'm trying to. Okay, so this is supposed to be the next slide, and so let me just make sure. I'm going to go to my hard copy here to make sure. All right. So yes. So, all right. So in order to open an ABLE account, the account owner must have a qualifying disability that began before he or she turned age 26. The account owner is able to save up to presently is able to save up to $27,140 each year in the account without affecting their medical assistance, SSI, and most other benefits. But the other benefit rules still must be met. Of that $27,140, up to $15,000 of that can come from any source, including the owner's family, friends, benefits, or other unearned income. Whereas the up to $12,140 per year can be saved by the account owner or the person with the disability who has a job, but it can only come from their own earned income. Now, for individuals with disabilities who are recipients of SSI, they're only able to save or put $100,000 total into their ABLE account before they become disqualified from continuing to receive the SSI cash benefit. And so once they get over that $100,000, they are no longer exempted from the SSI $2,000 individual resource limit, and therefore their ability to receive the SSI cash benefit is suspended until such time as the value of the account falls back below $100,000. Now, and then although the beneficiary's eligibility for SSI cash benefits is suspended, their ability to receive or to remain eligible to receive medical assistance through Medicaid is not affected. An eligible individual is limited to only one ABLE account, and and so they can't open multiple ABLE accounts and put in $100,000 of each. And so it does have a maximum value that you can put into there. Upon the account owner's death, the state in which the beneficiary lived or the account owner lived may file a claim to all or a portion of the funds in the account that are remaining equal to the amount in which the state spent on the beneficiary through their state Medicaid program. This is commonly known as the Medicaid payback provision. And the claim seeks to recoup all Medicaid-related expenses from the time the account was opened. So now, let me just see, that's a blank one. So let me just see where we go next. Okay, so hopefully this is it. Yeah, all right. And so then an ABLE account provides more choice and control for the account owner, beneficiary, and the family. The cost for establishing an ABLE account will almost always be considerably less than for establishing either a special needs trust or a supplemental needs trust. With the ABLE account, the account owners will have the ability to control their funds, and if circumstances change, they still have other options available to them. With this being said, for many families, the ABLE account will be a significant and viable option in addition to rather than instead of a trust. And as I walk through the different trusts, I think you'll have a better understanding as to why this works really well in conjunction with one or the other, either the supplemental needs trust or the special needs trust, depending on the particular situation for the disabled individual and their family. So the next option we're going to discuss is a special needs trust. And this is a trust that is established for the benefit of a person who is under age 65. It can be established just recently, within the last few years. It was amended so that the disabled person can establish a special needs trust. It used to be just the parents, grandparents, legal guardian, or the court was authorized and allowed to establish, and the federal government and the state Minnesota have now adopted where the disabled person can also set up the special needs trust, which is a big boon, and I'll explain why in a little bit. It is funded with the disabled person's income or assets. Assets of other individuals may be placed in the trust, but it's not recommended. And the reason that it's not recommended for people other than the disabled person to put money into the ABLE accounts or in the special needs trust account is because of that Medicaid payback. That applies to both special needs trust and it applies to the ABLE account. And so you generally don't want third-party money in an account that if there's anything left over at the end is going to go back to pay the government for expenses they've paid out. At least most clients don't want their money to be going to the government. They'd rather have it going somewhere else if they have that ability. And we'll get into how we can arrange that. So then it provides for the beneficiary's reasonable living expenses and other needs when benefits from publicly funded benefit programs are not sufficient to provide adequately for those needs. The disabled person must meet the disability criteria of the SSI program at the time the trust is established. Now, there are some ways to still set it up before it's actually established that they have a disability, but it's much better to get that established before you set this up because it just makes things a lot easier, smoother, and there's no question. I mean, if you try to do it after the fact, you may get it approved, you may not. So then you've got a serious issue if you aren't successful in getting it retroactively approved. A person with a disability established by the Social Security Administration or the State Medical Review Team meets these qualifications automatically. The disabled person must be the lifetime beneficiary under the trust, and the trust instrument must state that a disbursement from the trust must be for the sole benefit of the disabled person at the time the trust is established, as long as any time in the future. So at no time in the future can there be any beneficiary of the special needs trust other than the person with the disability. And as I'll get into a little later when we're talking about what happens when the disabled individual passes away, I think you'll get a better understanding why there can be no other beneficiaries other than the disabled individual. The trust is established for the sole benefit of a disabled person if the trust benefits no one but the disabled person, whether at the time the trust is established or any time in the future. Just reiterating that previous point. Disbursements by the trustee to anyone who is not the disabled person, whether in cash or in kind, are not allowed unless any of the following exceptions apply. And these following disbursements are considered to be for the sole benefit of the disabled person, and that's disbursements by the trustee for the benefit of the disabled person. So in essence, if the trustee wanted to, and I'm off the top of my head, I can't remember if this would be something they could expend or not, but if they wanted to, they could pay for a benefit not covered by a governmental program by, in essence, paying directly to that entity on behalf of. So I'm just going to throw out an example. If they wanted or needed to obtain a car that was suited for either them to be transported in or potentially for them to drive, the trustee could write a check directly to the car dealer paying for that car. So they're making the payment for the benefit of the disabled person rather than giving the money to the disabled person to pay to the car dealer. Or if they were able to seek additional education, similarly, you could pay directly to the educational institution on behalf of the disabled person rather than, again, dispersing the money to the disabled person to pay. So it just it works. That's how it is the best way to work. And so those do not count. So those still are considered to be for the sole benefit of a disabled person. Similarly, income taxes that are owed on income from trust investments or on income of the trust beneficiary assigned to the trust. Trust investment fees related to the administration of the trust. Reasonable and necessary professional expenses including trustee, accounting, and attorney fees relating to the management of the funds or property in the trust. And then finally, guardianship and conservator fees for the trust beneficiary when based on the fair market value for the services provided. So those are essentially the only exceptions for non-payments directly to the beneficiary. And then here we get into the trust is required to contain a provision stating that upon the death of the disabled person, the Department of Human Services or the state receives all amounts remaining in the trust up to an amount equal to the total amount of medical assistance paid on behalf of the disabled person. And although this is rare, it's possible that a disabled person has lived in more than one state. And if they have, every state has a claim against the remnants or the remaining assets in that trust. And if there are insufficient assets left to pay all the claims, then it's essentially paid out proportionate to the claims, so that every state gets an equal portion payment based on what was left in the trust at the disabled individual's death. And then the trust may contain a provision allowing payment of administrative expenses and fees this would occur prior to the payment of DHS if the trust states that the expenses and fees must be reasonable, or if it states that reasonable and necessary administrative expenses may be paid only if Department of Human Services is provided with advance notice and approves such expenses. Trust will not qualify as a special needs trust if it includes provisions that allow for payment of the following expenses prior to repayment of the state. And that is payment for last illness and funeral, outstanding debts or other payments, or the payment of administrative expenses or attorney and trustee fees if the trust does not require such payments to be reasonable. So it's really important that if you're having a special needs trust created, that you're working with someone who focuses on estate planning for individuals and their families with special needs, because it doesn't take much to muck up a special needs trust and to actually make it so it will not qualify as a special needs trust. And then that raises all sorts of issues with essentially eliminating their eligibility until there's a major spend down of their assets. And so it's really important that if you're going this route that it's done right. And now, just to give some examples, I'm going to go back here. So the best funding, most special needs trusts are funded with the assets of the disabled person. And where you see this most frequently is where you have, and it could be someone as young, I've seen them where they're children, it's young children, maybe 12, 14 or whatever, and they've been involved in a horrific accident, and as a result there was a lawsuit and a settlement. Well, the settlement is there as soon as the settlement is reached. It's theirs money. It's not a third party's money. It's their money from the insurance company or from the tortfeasor, and so that money is what goes into a special needs trust. That is the best funding mechanism for a special needs trust. You will also unfortunately see the need for special needs trust where proper estate planning was not performed, and you have a parent or a grandparent or a family member who leaves an inheritance to an individual with special needs. And at that point, once the family member passes away, the person with special needs, essentially, it's their inheritance is their money. It's not the third person's or the decedent's money anymore. And so unless they're going to disclaim it, which most people won't do, although there is the possibility of doing that, and that's a subject for another day, the only place you can put that money is into a special needs trust. You can't put it into an ABLE account because it's not earnings of the disabled individual, and you'd be limited to that $12,000 and change per year, and so it goes into a special needs trust. And then again, as I explained, because of that Medicaid payback that's associated with special needs trust and with the ABLE accounts, it's really not recommended that friends, family members put their own money into a special needs trust or into an ABLE account. And that's because if they're going to be putting money for the benefit of someone with a disability, the supplemental needs trust is the best vehicle to utilize. And like the special needs trust, it provides for the reasonable living expenses and other basic needs of a person with a disability when benefits from publicly funded benefit programs are not sufficient to provide adequately for those needs. The beneficiary, again, must have been a person with a disability before the trust was created. A trust will not meet the criteria as a supplemental needs trust if the beneficiary's disability was established after the trust was established. And again, the beneficiary's disability must be based on the Social Security Administration criteria. Verification of a disability meeting SSA criteria can be established through either the person's already receiving SSI or RSDI benefits, or they the state medical review team makes a determination that they have a disability. And just a quick note, if the beneficiary was not receiving SSI or RSDI payments for the disabled, at the time the trust was established, the SMRT must determine whether the beneficiary was disabled at the time the trust was established. And so this is where that sort of you can go back and retroactively establish, but it can be a sort of a crapshoot as to whether you're going to be successful in doing that. Hopefully you will, but it's just always smarter and advisable to wait until you've got that determination made before you create either the special needs or the supplemental needs trust. Similarly, a licensed professional qualified to diagnose to diagnose a disabling illness or condition. So a licensed professional must determine that the beneficiary has a physical or mental illness that substantially impairs the person's ability to care for him or herself. The condition must be expected to last for a continuous period of at least 12 months, and a second licensed professional of the same qualification must confirm the diagnosis in writing. And when you get all that, then you've got the establishment of a disability and can create the supplemental needs trust or a special needs trust.
Hey, Scott, to be clear, do you need both of those things or one or the other?
Oh, it's either the verification, because if you're already receiving SSI or RSDI benefits, then it's verified with that. Or if the state medical review team makes a determination of disability, you're okay. Or you can have two licensed professionals who make the determination that the beneficiary has a physical or mental illness that substantially impairs the person's ability to care for himself. So it's either receipt of SSI or RSDI benefits, or the state medical review team determining the disability, or the second bullet point where you have the two medical professions. And a lot of times, well, in a number of the cases I worked, it's usually the two licensed professionals who do it. But sometimes the people are, as I said, are already receiving SSI or RSDI. Does that make sense?
Yes,
and I don't see any questions yet, but if anyone's typed them, I have not seen them, so we'll expect. Hopefully you'll let me know.
Yeah.
So then with the supplemental needs trust, the beneficiary cannot be the trustee. It has to be a third party. And so the trustee can be the beneficiary's parents, siblings, other family members or friends, a professional trustee, or a trust officer from a financial institution. The trust is not enforceable for a beneficiary age 65 or older. So although you can create it, once they reach age 65, if they then end up residing in a state institution or nursing facility for 6 months or more, and due to their medical need for care in an institutional setting, there is no reasonable expectation the beneficiary will ever be discharged from that institution or facility, then the trust will as a matter of law, be terminated. So it will take you all the way up to age 65, and it can go beyond that if you don't run into where you're required to reside in a state institution or nursing facility. And I should say that a group facility does not constitute as a state institution or nursing facility if it's just like where a group of people with disabilities are living. In essence, it's there's support there, but it's not like a full-time care provision. The trust.
What happens to the money if it gets terminated, Scott?
We are going to get to that. So that's fine. That's the good thing that about the supplemental needs trust is it does not have that Medicaid payback, and so I'm going to walk through that. So a supplemental needs trust can be established by someone other than the disabled person or the disabled person's spouse. Must be established by either someone other than the disabled person or their spouse. It also must be funded by someone other than the disabled person, their spouse, or anyone obligated to pay any sum for damages. And this is where you get into sort of what I was talking about, where you might receive an insurance settlement or a judgment out of an accident. That cannot go into a supplemental needs trust. That has to go into the special needs trust. So that latter part there is addressing that. And then the supplemental needs trust can be funded either during the lifetime of one or more third-party grantor. So there are situations where a grandparent may, either during their life or at their death, put some funding into a supplemental needs trust. Parents usually will either during their life and/or at their death put it into the supplemental needs trust, and that. If you have an individual who has a disability, you want to make sure that in your estate plan, any distribution or inheritance going to an individual with special needs is going into a supplemental needs trust. because otherwise, and unfortunately, you run into this and why you have to scramble sometimes to quickly create a special needs trust. Otherwise, they exceed the income thresholds or the financial thresholds and become ineligible for receiving medical assistance, SSI, and a number of the other programs. And so in order to ensure that you're not going to disqualify your child or family member from receiving that, it's always smart to have a supplemental needs trust and direct any inheritance or beneficiary designations to go into that supplemental needs trust. The trustee of the supplemental needs trust may distribute funds from the trust for the benefit of the beneficiary, but it's only for purposes which supplement benefits from publicly funded programs in amounts as the trustee deems advisable. Now, I always use sort of a pie-in-the-sky analysis when I'm talking to my clients, just to give them sort of an example. And it's just bear with me here, but let's assume here that my wife and I are extremely wealthy. And so we have 3 children, one of whom has special needs. And so at the second of our deaths, our estate will be divided into 3, and 1/3 will go to our son with special needs, and the other 2/3 will go to our daughter and our other son. And the supplemental needs trust, the way I look at it is, it allows the child with special needs to live as normal a life as possible, equal to what their siblings could live. And so, for example, if we left an inheritance large enough for any of our children to take a trip around the world, the supplemental needs trust could be utilized to grant my son with special needs the exact same thing. It could pay for the travel, it could pay for the personal care attendant or whomever needs to go with him, so that he can live as normal a life as possible. And again, that's why, clearly government assistance is not going to help a person with disability to travel and see the sights and do things if they're medically able to do so. But it allows them to live as close as possible to the life a child without special needs would be able to live, by allowing the trustee to supplement what the government provides to enable them to try to live, as I said, just like their siblings would or do. But you cannot make disbursement. The trustee cannot make disbursements that are going to replace or reduce public assistance benefits that are otherwise available to the beneficiary. But other than, as long as they're not replacing or reducing those benefits, the trustee has the discretion to determine the timing and the amount of distributions. And again, a lot of these would be, just as we were talking about with the special needs trust, is it would be paying, if there was a trip, it would be the trustee paying the travel agency and paying, if need be, the hotel, paying all the bills on behalf of the person with special needs. They would not be giving the money to the person with the disability. And then because there is no Medicaid payback, this is where the parent or whoever's creating the supplemental needs trust can provide that upon the death of the individual's special needs, all remaining funds can be divided, and you could set it up that, depending on the disabled person's what their situation was. And maybe they were married and had kids, so you could have it go all to their kids. If there are no kids, then you could have it go to their siblings or to the and these would all sort of be if it'd be like to the children, and this is not the right language, but essentially the children of the person with special needs, if any, otherwise equally to the siblings, if alive, otherwise to the children of siblings, if alive. And so you provide where it's going, and in essence, you're sending it to blood rather than to the state, is where it is. And that's where this is, I think, just such a a great option, and this is where if we are able to plan, far enough ahead, this is where utilizing an ABLE account in conjunction with a supplemental needs trust can be those are great estate planning tools. And but sometimes you can't plan. If the person is involved in an accident and is going to be receiving a settlement, then you can do the ABLE in conjunction with the special needs trust. And so it comes down a little bit to what the factual situation is for the disabled individual and their family. But the ABLE account is a great tool to use in conjunction with one of these trusts. And now I'm just going to go through and summarize a little bit of just sort of the pros and cons that I've hit on already of each of the options. So for the ABLE accounts, the pros are that it provides more choice and control for the beneficiary and the family. Any person can make contributions to the account, although, as I've indicated, not recommended for anyone other than the disabled individual to make contributions to the account. Its cost to establish is generally much less than for a special needs trust or supplemental needs trust. The account owners have the ability to control their funds, and if the circumstances change, they still have other options available to them. And it can be used in addition to and in conjunction with one of the trusts. The cons are that it must maintain $100,000 or less in the account in order to maintain the beneficiary's eligibility to receive SSI cash benefits, and it's got that Medicaid payback requirement when the account owner dies, which if it's the account owner's money isn't, that's not the end of the world. But if people have put in third-party money, then that's where it can sting a little bit. And I've run into situations where, believe it or not, people were making distributions from a supplemental needs trust into an ABLE account. So they were giving up that exemption from the Medicaid payback by making distributions in there, which is, once I spoke to them, I'm like, don't do that. You don't want to, you can always address through other issues, but don't put money into something that has a Medicaid payback that otherwise is exempt from it. For the special needs trust, again, the pros, it can be established by any person. It should be funded only with the disabled person's income or assets, and it provides for the beneficiary's reasonable living expenses and other needs when benefits from the publicly funded benefit programs are not sufficient to provide adequately for those needs. And then I guess I didn't put all the cons. One is, again, the big one is that Medicaid payback requirement when the account owner dies. Another one would be, that it is more expensive than the ABLE account, although it's flexible. It's set up to the cost over time would probably be a great value, but the upfront cost is just more. And then depending on the situation, there's more, the management, who's going to be the trustee, and the expenses for managing it, I would say are also going to be sort of cons. But that's where utilizing, the members of your financial team, such as an accountant and the estate planning attorney, can really help to guide you through that and ease that process. But to some people, those are cons, and understandably so. And then for the supplemental needs trust, the pros are it must be established by someone other than the disabled person or that person's spouse. It must be funded by someone other than the disabled person, their spouse, or again, someone who's obligated due to a settlement or a judgment to pay a certain amount of money or an annuity or whatever the settlement was to the person with the disability. It's got there's a lot of flexibility in how it's funded because it can be funded by multiple third parties, whether at life or after death. And it provides for the beneficiary's reasonable living expenses and other needs when benefits from publicly funded benefit programs are not sufficient to provide adequately for those needs. Again, there's no Medicaid payback requirement when the account owner dies, So therefore, whoever creates it is able to distribute the trust assets that are remaining at the death of the disabled person to specified beneficiaries and contingent beneficiaries rather than it going to the state. And then that's pretty much it. If you have any questions or would like further information or would like to schedule a complimentary consultation with me, there's my contact information. Or if these are options that appeal to you, especially the special needs or the supplemental needs trust, whether you schedule the meeting with me or with another estate planning attorney who has a focus in special needs planning, I would highly recommend it. There are so many nuances that it's really important that you see first an estate planning attorney, not just a general practitioner, and then verify that estate planning attorney has a strong focus in their practice on special needs planning.
Scott, while I let people formulate questions they might have on that same subject, is there a particular qualification, like often attorneys and financial planners have a lot of letters past their name. Is there a particular one that would let us know that an individual is qualified in special needs planning? Or
No,
is that just a series of questions?
Unfortunately not. There are very few, the rules of professional responsibility essentially prohibit attorneys from clarifying them as specializing in this or being an expert in this. There are a few designations that the board recognizes, and a lot of them have to do with trial or with taxes, none really with estate planning, unfortunately, or even more particularly with special needs. Hopefully that's something that could be coming some point down the road if there's enough demand for it, but no, it's going to be just investigation, unfortunately. Maybe trying to look at their website, give them a call, talk to them, inquire, whether they do this, how often are they doing it, what's their experience with it, or what's their connection to it, And the ones you're going to find are usually they have a connection to either a child of their own or a family member who has special needs that has really that's created sort of their interest and their burning desire to help other people who are facing the same situation.
So for our participants, you're welcome to raise your hand and I can unmute you if you would like to ask a question that way. And you can also type into the chat box if you have a question and I can read it for you for Scott to answer. Scott, another thing that came up for me when you were talking was you mentioned, that an accountant and an estate planning attorney can be a trustee. Are there other people who can be a trustee, and how do we choose in any particular circumstance? I
said they can be advisors. I do not serve as a trustee for any of my clients. Usually off the bat, most trustees are family members. But the parents, if it's being set up by a parent, or even if it's being set up by a grandparent, then usually the grandparent will make sure that the parents are okay acting as the trustees. Where you then get into a little more issues is successor trustees to the parents, because it is a big ask to, without discussing it and getting the buy-in from a sibling, to just have them nominate them or have them serve as the trustee, because they're going to have their own lives to lead and probably with a family, so you just want to make sure. But there are professional fiduciaries out there who will serve as the trustees for this. There are banks that have trust departments that will serve as the trustee for this. And again, depending on the circumstances, there's the ability to essentially utilize, join in on a what's called a pooled fund, a pooled trust fund, and in essence, that's for a number of trusts that may not, it may not make economical and logistical sense for it to operate as a per se independent trustee, but if you combine them with a bunch of others, and they keep the, I'm not an expert on how they do it, but they somehow segregate the assets.
I think I saw one of those on the ARC Minnesota website.
And the whoever's managing the pooled fund has a way of segregating, or at least on paper segregating and tracking, what's going on in all the trusts that are in there, and then you're able. It opens up, a lot of options for investments and ability for the funds to do better and to reduce the administrative and operating expenses. So there are options, and so I would never just say that an estate planning attorney or an accountant should be or will be or would be willing to be a trustee, because to be honest, I don't know many attorneys who serve as trustees on these if they're still actively practicing. And I haven't asked any accountants, but I would be very surprised if there are accountants out there who, again, have a full-time practice who would be willing to serve as a trustee of a supplemental or special needs trust. Again,
Thank
unless
you for clearing that up.
Yeah, unless they have, again, a sort of a family, some kind of connection to the individual, whether it's a family member or something.
Scott, we have a question regarding the ABLE account. Is the $100,000 Social Security disability income eligibility limit based on contributions or the value of the account?
Value of the account.
Okay. Does anyone else have any questions for Scott? His contact information is here, and this webinar will be archived on our website at familyvoicesofminnesota.org. The part 2 of this series is coming up at the end of May. Oh, I forgot the date. And that will be on guardianship and conservatorship. I will send an email out to the group that attended here as a reminder for that. And there is a short survey when you exit the conference, and it's very helpful if you give us feedback, positive and negative, so that we can make sure that we're providing information that is relevant for families and that is actually helpful. So I would encourage everyone to take that. If there are no more questions, Scott, thank you so much. This was a lot of information, but I thought it was put together nicely, and I know that I certainly learned a lot today.
Well, thank you, and thank you for everyone who took the time to listen in, and hopefully you found it very helpful and informative.
All right, everyone have a good day.
Bye-bye.